Welcome to Real Talk, Real Estate Discussions with Andrew Kirsh. In each episode, Andrew interviews industry leaders. We'll hear their real-time opinions on today's market, their background and unique career highlights, and guidance for newcomers into the industry. You can find this show at scholarkirsh.com and on YouTube, LinkedIn, Apple Podcasts, Spotify, Google Podcasts, and more. Now here's the host of Real Talk, Andrew Kirsh.
64 of Real Talk. This week, I have Ivan Barratt of BAM Companies on the show. Now, Ivan focuses on what he calls the Heartland, and it's apropos that we bring Ivan on this week because we are doing a lot of transactions in the Midwest and the Heartland, whether it's Ann Arbor, Michigan, or Columbus, Ohio, or Indianapolis. More deals are happening in markets that were traditionally not in favor from coastal capital providers. And as the Sun Belt has some oversupply issues and some of the coastal markets are having regulatory issues that I've talked about ad nauseum, the Heartland has become a geographical location that a lot of our clients are turning to. So I hope you enjoy my conversation with Ivan Barratt. Welcome to another edition of Real Talk. I'm here with my good friend from YPO, living in Indianapolis, Ivan Barratt, founder and CEO of the BAM Companies. Ivan, how you doing, man?
I'm good, Kirsh. It's good to be here. Good to see you.
It's so good to see you. We're dressed casually. Usually I see you in a sport coat and real estate conferences. And whenever we get together, we have great conversations, and I'm honored that you're on the show. And I think my audience is going to hear some words of wisdom today.
I will do my best, my friend, to deliver some value for the audience.
So I only went to Northwestern. I think you went to Indiana. So is it safe to say that BAM Capital or BAM Companies, is that Barratt Asset Management, or what's the BAM?
It is. It was born in Barratt Asset Management, and it has become BAM. We're the BAM fam. We got a lot of BAMisms around here. We don't really say Barratt Asset Management anymore, but you caught it.
Gosh, it's that Northwestern education. We aren't good at football, but they do teach us one or two things. So talk about the evolution of BAM, how it started, and where it is today.
Yeah, gosh. So coming out of the GFC 08, 09, I was pretty banged up, but young enough to where it didn't destroy me. I was one of the lower ranking people on a development team, and everything, as you know, fell off a cliff. And I decided to hang out a management shingle. I wanted to do big apartment deals, but didn't really know how to get there, and thought, well, gosh, if I figure out this property management thing, start small, fail small, and move forward, that I would one day get to hopefully do some big deals. So it started off as a small management company, single family homes that people couldn't sell at the time, high-end condos. I had a bunch of duplexes and townhomes in some up-and-coming areas of the city. And I was building my own real estate portfolio, but as you know, real estate's capital intensive, and it takes a while to put a deal together. But if I could sell Andrew, out-of-state investor, on managing a couple of his assets, I could immediately get that revenue in. So I was a one-man band up until about 70 units, then started hiring people and beat my head against the wall for a while, hiring and firing and hiring. And definitely in the beginning, it was just a merry-go-round of turnover. And at the same time, I'm learning how to do little hard money deals. So I would buy multifamily, distressed assets, distressed sellers. I'm talking 2, 4, 6 units. And I would buy them, renovate them, rent them, refinance them, and then repeat. And started doing little apartment deals. Used the management company then to really scale into syndication. Some of my early management clients became some of my earliest investors. And my first big syndication deal was 60 units. I think I needed to raise like $700,000. And I got that done with 4 or 5 investors. From there, started only doing larger deals, 100+ units where I could afford on-site staff. And then once we got up to a few thousand units, we let go of the third-party management. Once we had enough scale to only manage for our own general partnership and our investors. We just continued to grow. I found some great people. 2015, we really hit a growth curve. Found a great operating partner, Ivan Barratt. He's the opposite of me. Much smarter, much better operator, great manager, and great assessor of good deals. And now today, we've transacted a little over $1.5 billion in multifamily, mostly acquisitions, but now we're also financing some joint venture developments with some folks here in the Midwest. We've still got about $1 billion under management. We've sold several assets, put some W's on the track record. Hit the Inc. 5000 for the 7th time in a row as one of the 5,000 fastest growing companies. That's pretty fun. But what's been really fun is now we are continuing to get great workplace awards. And back in 2015, after experiencing 5 years of property management, I had this crazy idea, Andrew. I thought, well, what if we had a property management company where people liked their job? And I was lucky enough to find people that bought into that. And, we just didn't know any better. And we figured that out. And today I'm most proud of the culture that we built here. We've got some of the lowest turnover of maintenance staff in the industry. A lot of people like their job here. Some of them even love it. We treat that company very, very well. It's not profit centered. It's more execution driven for the wealth management and creation side of the business. Now 1,400 investors. That started off real small with friends and family and some of those early management clients. And it's grown now to 1,400 investors across the country, putting in small checks, medium checks, and big checks, and everything in between.
Wow, what a story. I mean, I know I've heard some of it, but for you to just really concisely and succinctly just talk about that evolution story, did you ever think coming out of the GFC, buying some condos or managing some houses, then buying some duplexes and fourplexes and raising $700,000 that you would have over $1.5 billion under management?
The goal was always to have a big company. I always wanted to build a beautiful machine and an organism that could take on a life of its own. So always had the big dream. Didn't know how I was going to get there. And early on, I sort of dropped the ego and stopped thinking about big deals and just focused on the next small deal, and would put one foot in front of the other and not try to look up at the summit. Just keep climbing the mountain, one foot in front of the other.
Was there a deal or a moment in time over the last 10, 15 years where you said, you know what, okay, I've made it. Maybe the challenges and the rough start during the GFC days are behind us, and I just know that BAM is going to be successful?
There's definitely been those stops along the way where I stopped to smell the roses and kind of let myself be a little excited about where we are, and we've come a long way. And other times it feels like we're just getting started. But we had a 98 unit asset, bought it with a few investors and added a ton of value. Was able to get the staff right. It was an older asset, C-class, C+ property, and really got it humming. And we're able to sell it 3 years later for, I think it was like a 2.5 multiple on that one. So really great IRR. That was a lot of fun early on, having that first big home run.
Yeah. All right. So let's talk about BAM today, the types of deals you guys are chasing, both from location, deal size, vintage, value add, core. Give my audience a flavor of the types of deals that you're looking to acquire.
Today, it's mostly core plus assets where we have a high conviction of being able to deliver a value add return in excess of a 20 IRR. The
Is
last
that
2 years,
possible?
we have to be really, really disciplined with what we buy and where we buy it. But here in the Heartland, we've been able to find some really great value. I've still yet to find a deal that makes sense in the Southeast or any part of the Sun Belt because everybody knows the growth is there. But we've been able to find value. And now vintage, we're typically 2015 or newer. Class A assets in Class A suburban markets. As far east now as Pittsburgh, west to Kansas City.
Throw out a few markets that you have that you like.
Yeah, big concentration in Indy. We've got one great big deal in Pittsburgh, a little over 300 units in one of their nice suburbs. Same thing in Kansas City. We stay in the suburbs with good schools and good employment picture. And then a lot of tertiary markets that we know are really good back home in Bloomington, Indiana, Lafayette, Fort Wayne, these other tertiary markets like Des Moines, Iowa. We put a big bet on in Des Moines. No student housing, but we like some of those college towns with a really strong workforce. But we're all market rate rent, and our not so secret sauce, Andrew, has been operational efficiency. So as we've gone up in asset class, we target mediocre, underperforming management. We love deals where the owner is a large owner with a third-party manager we know is not doing maybe a terrible job, but not doing as well as they could.
Mm-hmm. And so, in our practice, I'm here in LA, but the deals that we work on are national. And, we've worked a lot in the Pacific Northwest and obviously throughout the West Coast and the Rocky Mountains and the Southwest, Southeast. And it's that Rust Belt, you call it the Heartland, where I would say I've done the fewest number of deals.
Good. Keep calling it the Rust Belt on this show. There's nothing to see here. There's no deals to be had. We're not the deals you're looking for.
With one caveat, I would say over the last 12 months, I've done more Midwestern deals than I have in 24 years. Deals in Columbus, Ohio, in Ann Arbor. I'm doing one right now in Ann Arbor. Not a student housing deal, but a conventional market rate deal in Ann Arbor.
Sure.
Looking at my board, some deals in like Southern Illinois or even Indiana. And curious of if you are seeing more competition from maybe the coasts coming into the markets where you feel like you used to have a monopoly.
Indianapolis, it's a great point. Indianapolis sort of goes through these patterns. So a few years ago when everything was on fire, I had to go to Des Moines, Iowa to find value because Indianapolis was in a position to where I was being outbid. My strike was, in some cases, millions of dollars lower than the highest bidder. Then it sort of came back in 22 and 23. We were able to buy some really fantastic deals in Indy. It feels again like it's sort of closed off, and I'm back in the tertiary markets looking for value. In some of these markets right now, it seems like a 475 is the purchase cap. The buyer needs a path to 550 or 6. They need to see some value add potential, but that going in looks to be like a 475 again.
And how does that compare to some of the tertiary markets? What would the in-place cap rate be?
Yeah, I mean, if I'm going into a tertiary market, I still might be in the mid 5s or high 5s on a cap rate. What I need a good 150 to 200 basis points of movement over the course of 2 to 3 years as I execute my business plan, bring in my management team, start optimizing operations, making sure all the fees are being charged, and the list goes on.
And so what about demographics and people moving in or out of these markets versus the Sun Belt, where over the last several years, Phoenix and Vegas and Dallas and throughout Texas and Florida, Nashville, Carolinas, huge influx of jobs and people coming out of COVID, people leaving California, leaving New York.
I get this question every other day, brother.
Right. And so how are the markets that you're transacting in compared to where people's perceptions are where folks are moving to?
Well, the Midwest doesn't boom, but she doesn't bust either. And so there's these
great. A song? I think that should be a song.
Let's make it one. You sing, I'll write the lyrics. No, so you have these world-class suburbs throughout the Midwest where you've got steady population growth. Now, it's nothing like you see in the Southeast, but as I mentioned a little bit earlier in the show, everybody and their cousin knows the Southeast is a great growth rate, the Phoenixes, the Vegases. And so when everybody's chasing the same growth rate, obviously it's gonna increase pricing and lower returns.
And what about, do you run into supply issues, meaning oversupply, overbuilding in the markets? Because what we are seeing is a lot of our clients who went into the Southwest and Southeast are now moving back to coastal markets and moving into Midwestern markets. But at least I'm not going to speak as specifically and as intelligently as you are on the Midwestern markets, but I can say on the coastal markets, it is hard to build here. And so when they see an endless supply in Phoenix and Vegas and Dallas and some other markets, it really has depressed rent growth and has made capital want to shift back to the markets that they left behind, like a California or Washington State or Oregon, where it's harder to build.
Absolutely. Barriers to entry is a big piece of the equation, and we're seeing that well. I think there's going to be some continued oversupply issues in some of the markets you mentioned. I think it'll be short-lived because starts have fallen off a cliff in most of those markets, so that eventually gets absorbed. And I think you'll have some developers who, if they can get a shovel in the ground and get going, are going to have a really good time filling them up a couple of years from now. Indy, we're definitely having to compete more than we were, say, post-COVID when the leasing office had a line out the door. So we've had to refocus, flex some different muscles, remember to pay attention to retention and maybe not renewing rates as high as we used to keep people in the door. But as I'm sure you know, a lot of the Midwest is still experiencing low single-digit rent growth versus a lot of other areas of the country.
Yeah. Now let's pivot the conversation to the capital side. 1,400 investors. I mean, that's really that's a lot. I mean, I don't know other way to say it. We had Jeff Gleiberman on a couple months ago, MG Properties, and he's a syndication machine, and several thousand investors. Keith Wasserman from Gelt, same thing.
Oh yeah, I love Keith.
Yeah,
Keith's cooler, but Keith's okay.
You know what? He rolls around in a Cybertruck here at the Palisades. So yeah, that's all I have to say. No, he's one of my good friends, and I give him shit for it. How was there? Did you implement technology, social media? How have you gotten up to 1,400 investors?
Well, it all started with friends and family and lots of referrals and repeat investment and more referrals. Some things don't change. You do well for your customer, and they are going to bring you another customer or two. Mm-hmm. And then the last few years, we've had to get really serious about customer acquisition as we've scaled our platform. We're constantly on the hunt for new capital, new customers, new relationships. We do a lot of that through social media, a lot of paid advertising across all kinds of channels. We've got some great people here that help make the socials look good. And then we've got some great people here too that track all that so that we can do our best to get a cost to acquire a customer, lifetime value of the customer, and those things dialed in.
Are you doing crowdfunding?
No crowdfunding. No. So we're all direct. We've been on some sites that some might call crowdfunding, but those are really just marketing distribution channels. Our minimum investment on a development deal is $50,000. You have to be verified that you're accredited by, as you know, advisors, attorney, or CPA. And then our funds minimum is $200,000. And so We do not collect any smaller checks than that. Now, in the grand scheme of things, those are still relatively small checks, but no crowdfunding as it's strictly defined.
And so when you're buying deals today, I mean, you mentioned development. What percentage of your deals are ground up development versus existing?
Oh, it's a small percentage. We put $200 million to work in the last 20 months, and $160 million of that was in our acquisitions fund 4.
Got it. So are all of your acquisitions then purchased through the fund, or are there side vehicles, syndications, or any other side investors?
All through the fund.
Yeah. Have you thought about capitalizing deals through a joint venture structure where maybe the fund would take down the GP co-invest piece and you would partner with a traditional real estate private equity company that would provide, the vast majority of the equity?
That's pretty doubtful. We've got our sights set on more institutional discretionary funds as we build the track record and the infrastructure to support that. But we've worked, my partner and I, very hard to build a slightly over $1 billion portfolio where we have full control of the entire portfolio. We're not going to be forced sellers of assets. I don't want somebody halfway up my what telling me what to do, or their new asset manager's got to prove their job, so they're going to run my team ragged. Instead of going joint venture private equity, I've built my own private equity platform.
Yeah, that's amazing. Now, do you provide, I thought I heard
you
earlier,
did.
So are you providing capital to other operators?
We are providing capital to developers. We're starting to look at other operators as acquisition joint venture partners. But so far, we've just helped capitalize ground up development in markets that we know will be successful with developers who've got a long track record that we know. We love being.
I was going to say we may have to talk after the show. I've got a couple of developer clients who are looking for some fresh capital. It is hard to find capital for ground up construction projects these days.
Yeah, it is. And we are getting calls every day from developers. Our Rolodex continues to expand as developers search for capital. And it's been a lot of fun to come alongside the ones we know and like, and you've got a great track record, and partner with them. Because as I said earlier, we believe that if you can get a shovel in the ground right now, you're going to have some really good lease up activity in a couple of years where there's very little starts to compete with.
Is there a return on cost that you are looking for that has to hit a certain hurdle?
Yeah, so the last few deals have been stabilized around a 7. I think they've all started with in a low 7 kind of range.
Mm-hmm.
And then we're really interested in backing into what's the IRR on a 3 to 4 year hold net to my investor, because to raise capital in that ground up development scenario, I've got to be confident that I can net back to my investor mid-20s or better IRR. And
so do you have a separate fund that purely provides capital to these developers?
Maybe one day, but right now it's those are one-off deals. So if you were to go to my retail store, right, my investor portal, you'd come inside there and see our 4th fund, a couple of joint venture development opportunities that one can invest in. And then we're also spinning up an evergreen vehicle for preferred equity and also some debt structures that we're capitalizing as well.
That's great. And I guess final question on the development capital, what's the minimum capital outlay or also the sweet spot that you're capitalizing on an equity?
Let's see. The equity check we're providing so far has been anywhere from 15 to 25 million.
Mm-hmm. That's great. So as we're entering, I want to say that we're entering a new phase in the market.
Tell me more.
Well, announced on Real Talk today, the new real estate market has started on October. What is today? October 10th? No, I feel like in the last 90 days that the capital markets have opened up.
Yeah.
The number of transactions have increased significantly. I think it's safe to say that the bottom in terms of pricing was probably fourth quarter of 23, maybe the first month or two of this past year. And there's just more deal velocity. And so my question to you is, as we're, hopefully with the worst behind us and we're entering into this, I don't know, new or better times, what do you want to see BAM achieve over the next 2-3 years?
Yeah, I wholeheartedly agree. We are entering a more maybe normalized period. I think the best of the buyer's market or depth of the correction is in the rear view now. The next 2 to 3 years, first goal is to keep doing this one thing really, really well. We want to continue to expand the joint venture side of the business, continue to raise more capital. I think the retail side of it could grow to 250 to 300 million a year of retail as the market normalizes. And then we are, again, working diligently to build out the infrastructure and the ability to have sleeves of institutional discretionary capital come alongside our retail investors who we have loyalty to.
Now you're sitting on, a company, billion and a half under management. I see on your website, 150 employees, 1,400 investors. What does Ivan do on a day-to-day level? Are you a real estate guy? Are you manager of people? Are you handling investors? What, and besides doing podcasts, what
podcasts all day,
every day? What's
I would give for the managing of people and being the real estate guy, I give my partner all the credit. He's better at that than I could ever be. As much as I love being a real estate guy, he's just way better at it. I'm much more on the equity finance side of the house, and it's my job to have the vision and decide where we're going to point the ship. And then it's my partner's job and the crew's job to help us get there.
Yeah. All right. So last question here. You talked about the challenges of the GFC, and we had challenges coming out of COVID. We've had challenges over the last couple of years with the interest rate environment. For people who are experiencing some tough times with floating rate debt and not being able to refinance that out and working with lenders, what advice do you have for them, given your track record, where you have shown that you can go from literally nothing to $1.5 billion company? There are people who are struggling and hoping that the next chapter they can be somewhat successful like a BAM. Wow.
We could do a whole other podcast on that, I think. And I don't want to sound too flippant, but I think it's so important as an entrepreneur, someone looking to grow something, that getting kicked in the teeth, getting knocked on the ground at some point is just part of it. And the only thing you really have to do is figure out how to get back up and not quit. I wish I had something more actionable than that, but that's really how I feel about it. I know a lot of people are getting kicked in the teeth right now. Some people got out over their skis. Some probably made some poor decisions, while others were very well-meaning and did the best job they could, and just were a function of timing. And I think investors respect transparency and disclosure, and it's not always the easiest thing to do, but hopefully in the long run that would pay off. I know I feel very lucky that I was young enough in the great financial crisis in my late 20s to not get vaporized and learn a lot of valuable lessons. And some folks are being taught those lessons again now the hard way. And unfortunately, in some parts of the country where things really got irrationally exuberant, there's probably still a lot more pain to come. But hopefully those folks can find some opportunities and raise some capital in spite of that.
Yeah. We see, we're obviously we're working with a lot of clients who are going through some challenges and have over the last couple of years. And the way that they're able to be candid and roll up their sleeves and work with lenders and not hide the ball, I've seen them come out a lot more successful and have a much more positive outcome. And lenders are more willing to work with you when you have that.
I feel very thankful that we're very concentrated with the big bank. You know, the merchants guys here in Indiana. They're a great partner. My biggest investor is the lender, and I'm hearing a lot of rumblings about debt funds sort of turning into loan-to-own shops in a lot of markets.
Yeah,
are you seeing that too?
Definitely, they are out there, and if some of them were set up to, I don't want to say predatory, but to take advantage of a situation. So look, some lenders are set up to purely lend, and they want to work with their borrowers, and
those are the best.
Yeah, and then there are others who were frustrated equity guys, and they pivoted to providing debt, and if they end up with the property, well, they have the track record and experience to run it, so they're not upset about that.
Right.
So look, on that note, Ivan, I wanted you to come on so you could tell your story to my audience about the history of BAM and going from a couple of duplexes all the way to what you've accomplished now, and the number of investors, and more important than that, just the reputation that you have in the business. It's really remarkable what you've been able to accomplish, and I just want to congratulate you and also thank you at the same time for coming on to the show. For those listening and not seeing, they can't see that little heart symbol.
Oh yeah, I'm giving Andrew the heart symbol for all of you listening, audio only.
Yeah.
I appreciate the kind words, man. Thank you. It means a lot coming from you.
Well, I only speak it because it's true, and I love our times that we get to spend together face to face, and hopefully that'll be sooner rather than later.
You're coming to Chicago?
Yeah, that's not for a few months, so hopefully we can run into each other before that. And
we're gonna blink our eyes, and it's gonna be April in Chicago.
I know. Well, good luck to your Hoosiers. Good luck to your Colts. Pacer basketball starts up in a couple weeks, so there you go.
Go Dodgers.
Friday. Good luck. Thank you.
Thanks, buddy.
All right, man. Take care.
You've been listening to Real Talk, Real Estate Discussions with Andrew Kirsh. You can catch prior episodes at scholarkirsh.com and on YouTube, LinkedIn, Apple Podcasts, Spotify, Google Podcasts, and more. Thank you for your positive reviews, comments, and for sharing the show with others.